Yes, prices have fallen off significantly. It's almost 60% down since mid-2014 levels. Too much of a good thing can be bad. So I think initially the flurry of excitement over low commodity prices is slowly morphing over worries whether it's more a supply issue or is, signals towards demand problems. And if you've seen global economies, US is gathering momentum, but it's still about 2 to 2.5% kind of growth pace. Eurozone and Japan is going the other way, expected to grow hardly, stagnant kind of an environment. So in this scenario, I think it seems to be half full, half empty. So the half empty story being that demand is not catching up enough. The futures are now pricing in a 50 to 60 kind of band for the Brent prices. And if it holds up there, like you just mentioned, if you're a net importer like India, you have significant economic benefits. Inflation, good for current account, good for fiscal balance, but not so if you're an exporting country just like Malaysia in the region, who just seen as export growth slow and also current account surplus shrink. So yes, I think give and take, it's a positive development overall, good for countries again which have an inflation problem, not so much for Eurozone and Japan, which is trying hard to get inflation back into the picture. But overall, we're looking at where the prices are going to settle in. I would think a 50-60 would be the range for the time being, especially that's how the markets are signifying it. CPI inflation was bounced off recently, earlier this week. I think the call for February meeting is going to be a close one. We are still in the camp expecting the RBI to defer the rate cut to until April, because they want to see, though, let's say there are three preconditions. You have inflation that's falling off, inflationary expectations expected to also come off because your global environment commodity wise is also weakening. But the third precondition, that being fiscal consolidation, is still to be delivered. Markets and us, we are confident it's going to be done, but then RBI would like to wait for the February budget to take a final call on that. So I would still put my money on the April meeting, so 25 basis point to begin with. But then again, I think cumulatively there's going to be only room for 50 basis point cuts in FY16, mainly because you're looking at what will happen to inflation when growth comes back. So your output gap that's narrowing, and also what's happening externally. US rate hike expectations have been pushed back, but if ECB takes action later this month, it could happen that the divergence will shift back towards the US Fed and hikes will be priced back in. If that happens, that's another risk that the RBI will watch out for. So coming back to domestically, I would think cut looks more possible in April, March a small probability, but not so much February.